Welcome to this week's edition of the Closing Bell. We are recording on a Thursday so we can get you some up-to-date market and economic news for the week. I'm here with my co-host, Mark, aka Pepper, or Salt, actually. I'm Pepper, I guess. You got the salt, the nice white hair there, and the wisdom,
Uh,
right? You,
Come on, get it straight, dude.
I know, I'm
I'm
messing it
Salt,
up.
you're Pepper, and I used to be Pepper, but now I'm Salt, and you're
Hey,
Pepper now, but someday you'll be Salt, or you'll actually have nothing on your hair, and it'll just
salt
be
or crispy, or I guess bald, right?
nothing on your head. So
Uh,
anyway,
hopefully not. Hopefully not. But I wish we could show our viewers and our listeners a picture of you with your black hair. Did you dye it jet black, or was it always just that color?
it was natural, but and my mullet was sweet, dude, especially in a helmet. It looked
Yeah,
good.
you get the flow coming out
Got
the
the
back.
flow coming out the back, looking good.
You got to bring it back. We got to bring it back. Bring the
No,
flow
I don't
back.
think so. I think we'll leave it there. It was pretty bad.
Leave it in the 90s.
Leave it in the '90s. So that whole mullet thing was just not a good deal. It wasn't a good look. Not proud
Oh,
of it.
well, at least you rocked it well. So
Yeah, there we go.
not
I
many
did my
people,
best.
not many people can. So. But we got a good one this week. I think we'll talk through some big economic news. Obviously, again, following up from last week, a lot of devastating war going on, lots of news, lots of false information out there. So you kind of got to wade through it. But we'll talk a little bit about the global economy and kind of where we're at and where we're going. But I think the main thing, the first thing actually we should touch on is recession is no longer consensus. Now we'll talk about our opinion. Well, I'll have you talk about our opinion here in a second. But it's important to note a lot of economists have come out recently, which you're seeing on our screen here, a bottom right chart, is actually that a majority actually predict that the U.S. will skirt a economic recession in the general terms. But it's fallen below 50% for the first time in a little while here. Um, so yeah, it's quite interesting that a lot of economists are thinking there's a less than 50% chance of us going into a potential recession. Now, obviously, what's our opinion on that? We've been talking about it quite a bit, but I think again, I want you to hammer that point home.
Yeah, we've talked about that in the past. I think that we've had an inverted yield curve for 18 months, which has always been a really good precursor to recessions. I mean, that's kind of what happens. And an inverted yield curve, just, again, as a reminder, is when short-term rates are actually higher than longer-term rates. And in this case, the 2 years have been really a lot, higher than the 10 years. But those are 10 years lately have been going up, especially this week. That's why the markets are getting kind of, unsettled because of higher interest rates on the 10 years. So, yeah, we've had the inverted yield curve, and we've talked about this past. Our opinion basically is, we should have already had a recession. I think we might have had a slight one, last year when we had a couple of quarters of lower GDP. We've been talking about a rolling recession where you've actually certain industries in the economy that have actually gone into recession. For example, I mean, think about travel, right? When we had travel, pandemic, everybody shut down. They had their own recession in that time, and now they've kind of come out of that and really are leading the economy going forward as the services, restaurants, food, out, all those things have been areas where people are basically. We're going to talk about this more a little later, but
Yep.
they're going out and enjoying life because they were shut up for a while. So anyway, I think that there's one idea that we have a rolling recession going on, and that's kind of what I've kind of leaned more towards that, and but I don't know. There's a new, the new twist now is really this escalating, war
Yeah.
and going on in the Middle East, and so that's going to probably help Powell somewhat in also tightening people's spending strings. I mean, I think people ultimately, when you have conflicts like that, I think it tends to bring people in to save and
Yeah.
hold on to their cash. They get concerned about what they're reading and watching on the news. So yeah, I think that's I think yeah, to that point. So I think we had a rolling recession, and we'll probably most likely get that potential soft landing that we've talked about too. That will be simply by luck and not by, I mean, because you don't plan those things. It's a chance that the Fed, if they do a nice job here and not raise interest rates anymore, which some think they will, but that's the other chart here, right? Is the percentage of do you think this is the last time we're going to have rate increases? So anyway, you can see there, I would lean towards thinking they're not going to increase rates anymore.
And Powell came out and talked about the same thing that you're talking about right now is, hey, we're going to be data dependent. The further tightening could occur, but with this survey, most of us in America think that, we're done. That's our consensus as well. Some think that, a little over 20% think that November could be it. Really don't think with everything going on in Israel, Gaza, potential I don't want to say World War III at this point, right? We're not going to jump to the
No.
conclusion here, but Iran jumping into the fray somehow. Who else jumps into the theater of war in the Middle East? Again, that's going to affect oil. That's going to affect the global economy as a whole. And again, even post, we talked about this last week. Even post conflict, markets tend to take that in stride and actually perform pretty well over the long term, even in times of conflict and war. So, again, I agree with you. I definitely think that we're done here, and it'll be seen, especially with rates, which we'll kind of go into here in a second. Long-term rates have already kind of skyrocketing here, which could prevent Powell from making any big rash movements moving forward.
Yeah, I mean, it's getting really expensive, right, to buy a house, and today we actually, this is Thursday, and we're right at was it
4.99.
4.9. We got to 4.99 at the high. Ended up at 4.88, but we got the 4.99 at the high today on the 10-year. So we're right at 5. And we, when you look at a chart, even last week, you could see we broke some resistance levels, and so I think 5 is going to be a really interesting area to see how the bond market reacts at that point. I could see us going a little higher than 5. But I think, and then possibly coming back to it and kind of sitting there for a while in that 5-ish range for the 10-year.
Good points, and that kind of is a good segue into this next topic here, which is U.S. home sales and existing home sales. So homes that have already been built that are being resold, potentially, based off of forecasts and estimates, will be about 4.1 million by the end of 2023, which would be the lowest level of sales since 2008 when the collapse of Lehman Brothers. So that triggered the global financial crisis. And again, not saying that we're not jumping there. So don't, go run off and tell your moms, your dads, your grandparents, hey, buy gold and hunker down for 2008. We're not saying that. It's just important to know, like, hey, mortgage rates, which have reared their heads over 8% for the first time since 2000. And that to you is probably still low comparative to your first mortgage, which was what?
Yeah, it is. Yeah, that's like I said, I had 12 and a half, I think was 1985. So, rates have definitely come back up. It'll be an adjustment period for the housing market to get used to that. And for, the consumers, and so forth. And, right now there's just not a lot. I know, like in where we are here in California, there's just not a lot of supply. I mean, there's not many people who want to sell their house and go buy a new house and pay that type of mortgage, right? Because they're all sitting on lower interest rate loans that they've bought in the last 10, 15 years. And so, you just don't have a lot of supply. So it's funny when you say like home sales have come down because, again, experiences, watching is how quickly a house sells when it comes on, but it's just because there's just here, I'm talking about especially, like I said, in this area, because there's just not a lot of supply. So you got a group of people chasing, not a lot of opportunities, and so they sell really quick, even though rates are high in here. So anyway, but overall, the definitely existing home sales are coming back down.
Great points there. So let's dive in a little bit about what you briefly mentioned before. So we've got surging bond yield, especially the 10-year Treasury note, and it's bringing the stock market to a little bit of a halt lately. People, again, even with conflict in the Middle East, Gold has jumped. It's up over 5%, which most of the movement has come since the start of the Israel Hamas conflict. But it's quite interesting to see kind of things that have transpired since the spike in yields. Now, uh, let's dive into a little bit. I know you talked about goods and services and consumer spending, but uh, you think that 5%, you think that's going to provide a little resistance? You think it's kind of off to the races if it breaks that 5% mark?
I could see a break in five, for actually a short time, just because of the momentum. But then I would say that might be a really good opportunity to buy, especially on the longer in duration, because again, with the war, slowing economy, if in fact whether it's rolling recessions or we're probably going to stay, we're going to have some growth in this quarter, for sure, based on just the time of year it is. But it's definitely going to flatten out. Our growth is going to be, I think, sort of minimal into 2024. All those things add up to, no, kind of with the Fed encouraging them not to raise rates and probably, if not staying paused for a while, and even, maybe you start getting rate decreases if we start getting into trouble again. If the economy starts really going down, high unemployment, blah blah, which has kind of been the goal, but that could happen really quick because those are all employment numbers are all lagging, so we won't even know we're down, for quite a while before you'll see it in the numbers, right? So I don't know. I think it's going to be an interesting next 12 months for sure.
And speaking of employment, initial and continuing jobless claims came in today, sub 200,000 for initial claims. Continuing claims have jumped up a little bit, not crazy. It's above 1.74 million, so above that psychological level 1.7. But again, still super healthy, strong labor market. Should continue to see that slow. But again,
Yeah.
we'll find out after the fact, right? Like you said, like before you know it, it'll be here potentially if
It
that
should,
were to happen.
yeah, it should slow down, that part of it. But again, okay, so this has been the most anticipated recession in really history, and so everybody, including consumers, us, all of us have been waiting for it to slow down. But the companies for sure, increased their cash positions. So it's going to be interesting to see how the corporations, even though we may slow down in here or whatever, we may see the actual the corporations themselves and their earnings might still stay pretty solid because they've already been anticipating a lot of the downside, right? I mean,
True.
that's gonna,
That's
and
true.
that's yeah, and that's why the markets, you can't really go by, oh, the economy, I think it's going to tank, the market's going to tank. And yeah, I mean, interest rates have been a headwind definitely right now to the market, especially on the growth side. And really, any of the industrial companies that have anybody has debt, if you're high debt levels, either personally and or um, you know corporately, those stocks have been getting hit because of the higher debt, demands on them, and they're going to pay higher interest rates. So it's they're losing earnings ultimately. So anyway, it's going to be. We'll see how well they adjust it, and if it ends up being like we expect, we should be able to roll through this. I think, though, that the current geopolitical issues can cause, they don't typically cause long term, but in the near
Right.
term could cause some discomfort, for sure.
Definitely could cause some. And so these charts here that we're looking at, so for the listeners, we'll kind of spell it out here for you. For the viewers, you can see on your screen here. So US retail came in hotter than expected for this past month here. It was expected 0.7% jump. It was up even more, a little bit more than that. But you look at the nominal spending. So just again, inflation adjustment is going to show with inflation what food and service in retail sector has done. Almost a 40% increase since the drop of over 20% in during COVID. So consumers still spending. Now, what are they spending money on? So I saw some really interesting usage of the word recession. Inflation. It was a funflation. So there's a funflation issue right now, as you can see in services in top right hand or bottom right hand corner here. Consumer spending is still spending a ton of money on services. Again, post COVID lag, we've talked a lot about that. People spending thousands of bucks on Taylor Swift tickets, which I personally don't understand, and a lot of other trips and hotels and amusement parks, all of the above, right? So there's been a funflation issue lately, where there's been a little bit of a contractionary period in goods, even looking at consumer stocks, which have been the lowest performers as of late, because there's less discretionary spending on goods because people are spending it all on services.
Yeah, I think, so why is that? Well, I think a big part of that is, my generation, I'm on the younger side, if you can believe it, of the baby boomer generation, being born in 62.
Yep.
But, there's a lot of money, a lot of people that are in a retirement, that are my age or older, that are trying to enjoy their life and get out and go travel and do all these things. That's one aspect. And that's a massive amount of people, especially here in
Yeah.
America domestically. The other thing I think, like I said, COVID, we talked about that, and that's a while back now, but, that was a long time of being afraid and, getting stuck in your house and all that stuff that, they tried to do to us. And so, I've had clients tell me about, hey, I want to take a trip next year, so, I mean, I'm hearing it even at the ground level of people that are wanting to do those things. And then also I'd throw out, I think part of that is, there's a lot of negative news out there,
Yeah.
and if you can kind of get depressed if you don't have a lot to hope in or whatever. I mean, you know, and the reality is, hey, let's go spend some money and go have some fun, just go do something fun. So nothing wrong with that, but I think that's part of the spending deal. But, at some point that will, that services number right there. I mean, it is funflation, but you got to eventually pay for things. So it's, that'll probably come down,
Good
into
point.
2024, I'm sure.
Good point. And that's something that we're going to continue to watch. And I think that, consumers should obviously watch their spending as we kind of enter times of uncertainty and even election years. Those times are always more volatile as we look at policy change, or which we can get into, at another time. But it's interesting looking at the personal savings rate was up over 30% during COVID. Averaged about 5% earlier in the year, above 5%. It's down to like in the threes, into 3% range right now, which is concerning, right? People are blowing through their pandemic savings that they've using it on going out for funflation and going to whatever fun stuff that they want to do in the service sector, which has propped up the economy in the short term and made it stronger. But again, if you're running through your savings, what happens? You got to pay the piper.
Yeah, you got to pay your bills at some point, I guess, unless you're, yeah, never mind. I won't even go there. Unless you're, yeah,
Yeah, unless you're going to planning on
never
going
mind.
bankrupt, you're
Never
planning on
mind.
getting out of Dodge. But yeah, that's something that we're going to watch, which could cool the economy really quick. Again,
Yeah.
on many levels. So interesting to watch from that point. But the last thing I think we wanted to cover this week here is China. Okay, so China has always been an interesting place, right? You think about emerging markets, China is the biggest piece of that, but it's not looking so great anymore in terms of overtaking the U.S. as the world's biggest economy. That's always been the talk. Oh, China is not if, but when they're going to be the world's largest economy. Well, I mean, if you look at the restrictive policy that they have, and then we can kind of get into which you and I have talked quite heavily about is the debt, the debt laden banks of China, and how that could basically have the floor, which is rotted and decayed, just fall out from under you. So initial thoughts on China, investment opportunity, kind of bypass maybe at this point, and thoughts on the economy for China moving forward.
Yeah, I think that China is, they're not going to change their desire to be a world power. That's kind of embedded in the politics of what that company's or what that country is all about.
Mhm.
So that's not going to go away. But in the near term, they've got some internal issues that are pretty big. One is unemployment, and especially with young people.
Mhm.
That's the message and all the beliefs there. I mean, it's not with what they did in COVID and how long they locked people down. And I got some friends that ministry friends that live in China. In fact, I was in Beijing, right before COVID. Before it started.
Yeah.
Fortunately, wasn't there. Yeah. So we're there the year before that all came down, and it was very active play. I mean, it's crazy. And then to think of how they shut all those people down in those those apartment buildings in Beijing. I mean, it's I can't even imagine what that's like. And I know walking through that with some of our friends and seeing them,
Mhm.
that was very, very hard for them to deal with. And now they come out, they finally opened, and but you've got unemployment, you've got real estate with interest rates and all this, and then there's a massive amount of loans and banking potential banking crisis is there. It's just something. I guess the point what we want to say today is just like that's an area we're not hearing much about, but it's going to be really interesting to see how some of this economic turmoil works out in China. They're losing a lot of business, a lot of companies, including U.S. semiconductor. I mean,
Yeah.
we're
Yep.
going elsewhere for business, and so how that plays itself out over the next 12, 18 months is going to be really interesting. So yeah, and then as far as they're aligned with Russia, blah blah. There's a lot of things there that are going on. You got to see how they handle the other issues around Taiwan and things like that. So anyway, keep our eyes on China, especially. I think this banking issue is going to be bigger and bigger, and probably more in the news as we go forward.
So speaking of the banking issues, so when you were in China, you probably saw a lot of urban development, didn't you?
Yeah, yeah,
Yeah. So
yeah.
that's been the primary issue. Oh, go ahead.
Yeah, no, it's the urban, and it's crazy there how just piled upon each other and all this stuff that was going on. That's been 3 years now, going to be 4 years, I guess. Um, and so 3 to 4 years ago. So again, all that kind of stuff shut down, and then now you got all these loans that are out there, and so the banks are sitting on them. Fortunately, it looks like the domestic banks there in China are holding on to most of that debt,
Yep.
but you just don't know once the dominoes, if and when the dominoes start to fall, if it brings in more of a global aspect to that. You know, yeah, depending on what foreign banks and what their investment has been in China themselves, it's going to be really interesting.
And here are some stats on that. So I want to get into some real estate stats and how big of an issue that this could be for China's economy. So speaking of urban development, that's why I asked you the question. So basically, local governments they extensively borrow through off-balance sheet financing vehicles. So taking on debt, things of that nature, to finance that urban development that you were talking about.
Yeah,
Now, the local governments account for 45% of the country's GDP. So local government debt accounts for 45%, almost half of the country's GDP. Now, if these debts are incorporated into China's government's debt that they have, then it would surge to 149%,
right. A
almost
GDP.
1.5 times their country's GDP by 2027. So talk
Yeah,
about the floor falling out is, you have higher delinquency rates, especially with where the economy is at right now. And if they try to restructure it, it could be about $465 billion of additional debt that it could bring onto the banks. So it's a big issue. And again, but like you said, so does that mean, oh, this is going to ripple into the global economy massively? Probably not, because it's all the debt is mostly owned by the Chinese government. So it's not going to be hopefully as widespread. You just might see smaller ripple effects into the larger global pond. based off of trade or buying goods and services maybe from Chinese companies, whatever it may be. But it could provide pretty catastrophic for their economy in the near term and moving
Yeah.
forward in the next decade.
Yeah. And then, so what does that mean? I mean, yeah, it's been a big player. It's just, like I said, it's going to be super interesting to watch. And we're in an interesting time. I mean, again, we mentioned this last week a little bit. I mean, I know for myself as a Christian, reading the Bible and, prophecy, it's really, it's just really, it's ironic how a lot of things seem to be coming together. And China is just going to be in the midst of that, because of
Yeah.
where they are kind of positioned um, with Russia and different things going on. And now with Israel being surrounded again, which is very prophetic. All to say though is that we don't know the future. None of us do. And so it's going to be really interesting and to watch it and pray
Yep.
through it and see what's going on. As investors, it stays to the fact, because we don't know the future and what's going on there, is for us to begin to make sure that we're being good stewards of what we have, what
Mm-hmm.
God's entrusted to us, and then we are able to diversify that in places where we, whether kind of market we get, we'll be okay, or we'll at least be able to manage it through the wind and the storm. So feel pretty good about that, and that's important for us to continue to do. And I think that's our role. Pepper, salt and pepper. That's our role is with our clients, is to kind of provide that kind of service to to stay diversified, because you never know. Again, I was listening to a podcast earlier today, actually, it was talking about a very veteran investor who's been managing money for years, and this fact is like, the market just does what the market does, and it'll
Yep.
go, when you feel like it's going to drop, like it's going to go down, is like all of a sudden it goes
Skyrockets.
up. It's like totally different. So there's no way to time it or know. You just have to take advantage of the fact that, you want to be invested in good, solid companies that are making money,
Mhm.
selling good services and products. And,
There you go.
with a fixed
Preach it.
income portfolio, that's really good. So, yeah, that's good. Good stuff.
So, and again, I'm always optimistic. So even when we talk about all this geopolitical drama and uh, sadness in the world and horrible, horrific tragedy, I'm optimistic not only as a Christian, that believes in eternal life, but even here on earth, we talk about um, living in a free country. We're very blessed. We're thankful, even though, you know, things might not be going in the right direction, whatever we may believe in as individuals, being allowed to think like that, being allowed to have a free voice and the opportunity to invest, like you said, in great companies that are at the forefront of ingenuity, innovation, that can grow and basically portray that American spirit, that indomitable will that we built the foundations of this country on. And it even said on our coin, "In God we trust." So that's kind of like the foundation, the building block of where our country started, and it's grown to this. Now, again, it's our jobs as stewards to not only as our clients' money of our clients' money, but as Americans to make sure that we continue the ship, and be the light on the hill on the
Hmm.
hillside for the rest of the world and be a good example. And yeah, that's me
Yeah.
on my soapbox. I'm getting down now. I'm out.
That's good. That's good. Good job. No, I love it. I mean, it's there's a lot of talk going on, and I think having a base, solid rock foundation um, in Scripture is really important, because the winds blow and the storms come, and you know, um, in Christ, our house stands firm. So I think that's
Yep,
important. And right now in our world, man, we need to be sharing God's love, loving people. I mean, it's a hateful place right now. I
absolutely.
mean, I drive down the street, is coming to work to yesterday, and I'm like, oh my gosh, you got people. I mean, I'm not a bad driver. I think I'm pretty decent, but it just seems like war out there. Like just everybody's positioning
Yeah.
themselves to go faster. And I know it's crazy. It just seems like a crazy, interesting time. So take a step back, take a deep breath and relax, and you know what, and trust things are going to be good. We do live in a great country, and that's the problem. That's the most negative I see is watching other people who live here don't realize how great this place is,
Yeah.
and the freedoms we have. There's some concerns that some of that's going away, and that's a big concern, something we need to really truly fight for
Yep.
in our country. But we live in a great place. I was, again, watching the news. You just like you watch people that are able to protest in this country. That it seems crazy what they're protesting, right? But at the same time, we have a country where you're free to do that,
Yeah.
and it's crazy to think about. But
It is.
you can't do that anywhere else.
Nope.
Um, in a rational, nonviolent way. That sets this place apart from. Now we may not agree with that. I don't agree with what they're saying or anything like that. But the
Right.
fact is, my father, he fought in World War II, actually, for the right to give people the freedom to give their opinions. And
Yep.
that's kind of, yeah. So that's where we could get into some crazy stuff here, but it's not necessarily financial. But anyway, yeah, we live to your point, we got a lot to be optimistic about too. It's very exciting times.
Love it. I love it. Well, that's Salt and Pepper getting off our soapboxes here. We love doing this every week for you all, and we hope you have a wonderful weekend. We'll be back with you next week for another edition of The Closing Bell.
Closing bell. God bless.